Hey everyone, hope you're doing well. And this is Drew Creeker. I'm here with John Creeker, our Senior Wealth Advisor. And today we're doing a deep dive. We're going to dive into kind of the state of the market and what we're doing about it, and kind of talk through some of the tools and strategies that we are implementing in our portfolios to help us navigate what is setting up to be a really, really tricky market and economic time period. But before we get too deep, John, how you doing?
I love what you said there. What we're doing about the market being down. I think I just want to push it a little bit higher so it can go up a little bit, right? And um,
Yeah.
that can be a good thing. Exciting. I'm sure not sure how much control we have in that, but I'll tell you what, it's interesting. As cool as the market has gotten, it is just heating up outside. So I'm doing well. I'm enjoying it, enjoying life, and having a good time as we all navigate just really kind of unusual times right now. We are heading to kind of
Yeah.
one of my favorite celebration times of the year, though, coming up in a couple weeks. And Drew just popped that on the screen, didn't you?
Yep, I did. So we here at Creeper Wealth, we are, what are we, John? Are we hosting? Are we the title sponsor of the Morton Community Independence Day celebration on July 3rd?
Yeah, so in Morton, Illinois. So if you're in Central Illinois, the Independence Day celebration in Morton is, which is just our office. I can actually look down and kind of see where the field is. We're going to shoot them off down on Tennessee Avenue on the edge of town. It's on Sunday, July 3rd, and we are the sponsor of this event. There's a couple other sponsors that have some specific things, and we are the headline or sponsor on the event for this year and for the next couple of years. And I just love Independence Day. I love the actual time of year. I love getting together with family at that time and just kind of hanging out the park and watching big loud explosions in the air. I also love really kind of it's a celebration as far as the founding of our country and all the great things our country stands for. A lot of positives there. So we have a special area. It's actually an enclosed, fenced-in area where the Morton High School soccer fields are. And so we'd love to have you, invite you to come out, and we'll start setting up about 6:30 or so, and we'll be there all the way through the end of the celebration. And there's also food vendors there. We have a live musician that's going to be there starting at 4 o'clock, running 3 different sets, I believe, as far as with music, and specific kids zone. And then if you want to have some reserves feeding, it's just call the office and let them know. But it's a great celebration time, actually.
Yeah, for sure. Looking forward to it. It should be really fun to get together with everyone and celebrate July 4th. So give the office a call. We'd love to see y'all. So, John, let's kind of hop into it here. And I'm going to share my screen, and we're going to use this chart to walk us through how markets are doing so far this year. And so, year to date, we've seen a lot of different things happen. So we are in a technical bear market, which is when the market is pulled back by over 20%. That is the S&P 500 is down 20.59%. The Nasdaq is down 29% year to date. And what's interesting is that purple line. That is the total U.S. aggregate bond index. So all the bonds that are publicly available here in the U.S. So far this year, that index is down 10.94%, which is actually the worst start to a year for bonds since the 1880s. And so, John, what we're seeing here is some correlation that typically does not occur with stocks and bonds moving in tandem together. And so, you kind of walk us through just how should we view this big picture of where markets are at, maybe why, what in a short sentence has gotten us here, and kind of where do we go from here?
I'll tell you what, the it's this 2022 has been an interesting year, and not because we have a bear market, and typically we see a bear market every 3 or 4 years, and that's when the stock market drops by 20% from its high point. And a bull market actually is when the stock market bounces up 20% off the low point. And so we have those every 3 to 4 years. That's pretty typical. We had one in March of 2020, and that one lasted about 1 month, actually, less than 40 days. And so
Yeah.
that's pretty typical. Generally, though, whenever we see the stock market drop, people go to a risk-off investment, and so they look for safety. So what they do is they actually shift money from the stock market, and they don't go to cash, but they go to bonds, because historically bonds pay more interest than what their savings account or money market account pay. This year, though, with interest rates having gone up, we know the Federal Reserve has increased interest rates 3 times so far, up 1/4 of a point in March, up 1/2 a point in the month of May, and up 3/4 of a point in June, anticipating to go up again another at 1/2 to 3/4 of a point in July. So whenever interest rates go up, then the value of bond investments actually go down. So the unusual thing that we're seeing this year is that the stock market is down 20.59% on the S&P 500, and the iShares U.S. Aggregate Bond ETF is down, which is a good benchmark to use for the bond market. So the safety investment's down 10.94%, and which is the worst start of a year for I think almost in the history of the stock in the history of the bond market.
Yeah.
It's definitely the worst start of the year for the traditional conservative 60-40 mix. It's the worst start of the year in that. The first 5 months was the worst start of the year in the stock market since 1932. So whenever we look for safety, where do we go? And if you want to hide out in bonds, you're down 11%. The reality is that they're probably going to go down more throughout the rest of this year, as the Federal Reserve has mentioned time and again that they're going to be increasing interest rates throughout this year.
Right. Right. And so, John, you mentioned the 60/40 portfolio, which we pulled up here. That's the blue line. That is the Vanguard Balance Index Fund. That's a 60/40 fund. I'm also going to pull up here a Target Retirement Fund, which a lot of folks have available to them, either one of these two funds or a variation of it inside of their workplace retirement plan. And we know that for most individuals that we work with and just people in general here in the United States, your largest retirement asset is generally your retirement plan at work. So your 401k, your 403b. And so when we look at those plans, typically it's your statement at the end of each quarter, it's looking like this is going to be one of the worst time periods that these funds have ever performed in terms of their investment return so far this year. And so when we talk about people's biggest asset, and you kind of said, hey, how do you go to safety? What are some things that people should be looking for either in their workplace retirement plan that they can implement to help reduce risk, if any?
Yeah, so I think one of the great things to do is take a step back. So as you mentioned, largest financial assets for most people is your workplace retirement plan, your 401k. The number one selected investment inside of the 401k nationwide is actually a target retirement date fund. And so what the target retirement date fund is at different dates, typically it's in increments of five. So 2025, 2030, 2035, 40, 2065. Well, that's really tied to your retirement date. And so the further away you are, the more risk, the closer you are, the less risk. And so in this case here, Drew has a Vanguard Target Retirement Date Fund that a lot of people have inside of their 401k. We have 2025, which is the date that you're going to be accessing the funds or retire. And so within 3 years of that are a very conservative position. And so even with that very conservative position, it's down 16.22%. So if you're within 2.5 to 3 years of retirement, you're down 16%. You're in a position where it makes retirement kind of really a little bit uncertain for you. So it presents some issues. We also need to understand back in 2008, whenever I ran this the first time, we know the market dropped about 52% from the high to the low. The Fidelity retirement date of 2005, so actually 3 years before 2008. So you should have been mostly in cash. It was down over 40% in that year. So so we know that the risk is not always aligned there, and a lot of people have more risk in their target date than what they assumed. But it's not just a 2022 phenomenon, is it, Drew?
Yeah, it's true for all the target retirement funds. So, John, what should someone do who maybe gets their statement here in a couple of weeks on their 401k and they're reviewing it? Should they give us a call? Is there anything that we can really do to help them? Or are they just say, hey, you only have 20 funds available to you in your retirement plan. That's all you can access. That's your options are limited. Can you kind of walk us through some thoughts on how people should maybe plan to reposition those retirement plan assets for what's looking like a pretty interesting, bumpy, maybe volatile road ahead in the next 6 to 18 months?
I'll tell you what, there's a number of things that you can do. So number one is don't freak out, because your statement will be a lot lower in the month of July than what it was in the previous quarter. So that's step number one. Number two is I definitely say give your advisor a call. And we have got some, always our usual technology tools and forecasting out where your current balances are, how it affects you for retirement. We actually have some new tools we're bringing online that do a phenomenal job in communicating how has the last 6 months actually impacted your retirement income. So definitely give your advisor a call as the first step and have a dialogue about how are you positioned long term to accomplish your goals. Secondarily is to also get copies of your statements and your current holdings over to your advisor So we can begin to evaluate, number one, how much risk you actually have, and are you properly aligned long term to achieve your objectives, or something needs to happen. Now, with that, moving forward, we have a number of great resources that are rolling out right now. And so we're actually partnering with a technical trading firm, which you can sign up for trade signals. So if you're limited on your investment options inside your 401k, you can actually sign up for actual technical trade signals from them. And as far as what to buy, when to sell, things like that. And
And I
then
will say,
second,
John, on that tool, like many things here, we beta test these tools ourselves. And so I use my personal 401k for this. And I've been sitting about 40% in my money market fund or in short term bonds for the last few weeks based upon their signals. And so that's actually been very beneficial. So that's a great tool for if you just only have those base funds. Is there anything else they can do, though, to help better diversify or reduce risk or reposition those retirement plan assets?
yeah. So the other thing we can do is we can look to see, do you have a self-directed option available in your 401k? And if so, there's different tools. And so the same buffer strategy that we've talked about, a lot of people incorporating options into your IRA or standard investment account. You can also incorporate inside your self-directed brokerage account inside your 401k. So I think there's different options like that. That we have the ability to manage risk appropriately. So number one is to make sure you have the trading signals. Number two is to make sure that we also have different tools available to you to make sure you can understand your level of risk in that.
Yep, absolutely. So what we would say is definitely give your advisor a call. If you have any questions about, hey, can we make sure my retirement plan is in the right place to navigate the months ahead? And so, John, I think you kind of alluded to something that I think it's always good to kind of end on during periods of volatility, which is mindset, which is behavioral finance. You said, hey, these things come and go. They happen every couple of years on average. Typically, whenever you enter a bear market, the bear market on average ends in 46 days after you cross that threshold. So we'll see if that holds true or not. But John, just from a mindset perspective, how should people be thinking at this moment in time?
Yeah. I think the main thing you want to be thinking about is take a step back and say, what are your goal objectives? When the goal objectives really have to deal with two things. Number one is your time frame, and number two is the dollar amount that you need at that time frame. And so, if your time horizon is less than 3 years, you'll view things differently as it relates to the market, and your actions should be really appropriate for that time frame. If your time frame is 10 years or 15 years, well, the way you want to navigate this is a little bit different. And so you want to take a step back and say, hey, what are our goal objectives? And let's probably define them on a time frame and a dollar amount. And then once you have that, really to ask yourself the question of, am I aligned to be able to properly execute that time frame horizon? And if not, then what adjustments need to be made, not just for today, but also into the future. And those are things that our advisors, the Criminal Wealth Advisors, are very adept at doing, and that we can really would love to help you out as far as you navigate your next statement period.
Awesome, awesome. Well, I hope you found this helpful and help provide some perspective and some action items for you to keep front of mind. And so definitely give us a call. We'd love to see you on July 3rd here in Morton for the fireworks. And if you want us to take a look at your retirement plan or just to revisit how your overall financial plan is doing amidst all this volatility, we'd love to do that for you. So give us a call and shoot us an email and we'll take it from there. Thanks, guys. Have a good one.